Welcome to Womenetics Digital Library, today's imperative for business success.
Let's think a little bit about where our sources of money come from. Let's think about particularly that initial source of capital that an entrepreneur is going to consider. And you started your own company, you purchased real property tax advisors. Tell us about what entrepreneurs can expect with respect to self-financing. How much money do entrepreneurs have their own have to put into the business?
Well, I can't tell you how much I've put into it. When I bought the company in 2002, I bought it from another woman, and she'd been in business for 32 years. When I bought that company, I used owner financing, and she financed it for about a year, 18 months, and I paid her out. I put some money down and amortized it, paid it out over 18 months. And the company was self-funding, and we were able to do it off of existing business and started growing the business. Do you want me to keep going through the whole story?
We'll get to it. But let me focus a little bit more. Maybe ask Kelly too, in terms of building a business from an entrepreneurial perspective, and maybe also from the banking perspective as well. Are entrepreneurs expected to come out of their own pocket? I mean, don't always we hear about, hey, let's try to figure out a way to use other people's money. Should we try to limit our exposure? I mean, where are most people going to get their money if they're going to start a business? What are sort of the sources that they can pull money from now?
Does everybody understand the concept of venture funding? Okay, so venture funding is a bunch of people who are my best friends in the world, but they could care less about your financial situation, nor whether or not what they're doing is good for you. That's really not their priority. And how you got to the point where you're standing in front of them. That's just not their priority. It is, love these people, love these people. Venture-backed right now with OmniLink, venture-backed with Knowledge Storm. It's a very different kind of funding, and you make a pact with the devil when you do it, and it's not that they're the devil, it's that you have lost control. Yes. The minute you do it. It isn't your company, it's their company. That's a very different kind of thing than either owner financing or self-financing, and if you put $5 in and get a good outcome for yourself, that's great. If you put $1 million in and get this equally good outcome, that's great too. To a venture capitalist, if you put money in, they got you to the point where I've taken a meeting with you. That's kind of the extent of their interest of the journey. And I'm making it sound like they're horrible, they're also the #1 source of small companies. Janet was venture-backed. Mm-hmm. Small companies that grow to large companies, they are the #1 source of providing the fuel to allow that to happen. Your other options as an early company, not self-financing, and you know, how much money should you put in? You should put the money in that you feel comfortable putting in. And if you can get it to the point that it's successful, that's wonderful. If it isn't, if you can't, you know, that's a personal decision you need to make. It's really hard to be self-funded. Very hard. It's so much easier to go with other people's money on the point just made. So your options are angel financing. Angels are you and me. They're people who have some extra money who want to invest in things. They're hard to find right now. How do you feel about investing in other people's companies right now? Angels there aren't a lot of them right now because we're all under stress. Venture, private equity follows venture. You have to be much bigger than you are. OmniLink could not be private equity backed. I mean, we're a multi-million dollar company a year, and we could not be private equity backed. So it's for a bigger company than somebody like us. But if you can get that kind of success going, then private equity is an option for you. On the specific question, how much money should you put in? It's your money, and you have to make that decision. The thing I'm trying to make sure and get across is no one cares how you got to the point that you became an interesting company. No one in the VC or the money community cares how you got to the point that you became interesting enough to be standing in front of them. So it really does need to be driven from what your tolerance for investing in yourself and your company is.
We went through a capital raise in late 2008, You want me to go through this?
Please, yes.
Okay, well, back up for a second. When I bought the first company, the first thing I did was find a banker. And I can tell you they're your best friends. And always go to your banker before your banker comes to you. Okay? Just keep that in the back of your head. Okay, so we spent a few years growing. We entered into a capital raise the end of 2008. Okay, bad timing. We thought we could do it, and I ended up making a decision about 6 months later to just withdraw from the capital raise, purely a market-driven decision. We actually did end up securing part of the capital we needed, but it just wasn't going to work the way it was supposed to work. And a big part of the problem was the WEB certification. And the investors just couldn't get over the control issue. And I have so many clients that want that WEB certification. So I made the decision to withdraw from the capital raise. What I ended up doing was we formed 2 strategic alliances with the companies that we were going to roll up on the investment capital raise. And so those are in place. And then we also formed a partnership with one of the largest real estate companies in the U.S. And so that's how we have continued on our growth pattern. And that's where we are today. So we did all of that in the first 6 months of 2010 after terminating the capital raise.
And friends and family, anybody have any experience having some friends and family money come in? Janet talked about it a little bit this morning, some of the opportunities of having friends and family, and then also some of the pitfalls of having friends and family money in there.
I don't do friends and family. I don't do friends and family. I'd rather have friends and family.
Yeah.
Keep them.
I deal with quite a few companies that's the route they go. I mean, that's who you know, and that's oftentimes when you're just getting started, that's the first place to go. One thing though that we see is you've got to be very careful, and like Janet said, you've got to really set up the rules, and maybe that is going ahead and forming a partnership, getting a partnership agreement. We also find that some people put all this money in and you guys aren't tracking it. So then you bring on a partner, say, you know, an uncle puts in 10 grand. You don't know how much you've already put in. And so what kind of partnership is this? Does he get a 10% influence of your business? Those things aren't always discussed up front. So what I will say, family and friends, it's easier to talk about it up front. Are you giving up creative control? Are they just an investor? So that's something you really need to consider. Do they think that they have creative control? Because that's what we don't see lined up. You know, some people think I'm buying in and I'm buying into ownership instead of just an investor. So make sure that you have an understanding when you take from family and friends what you're giving up for that investment.
Another thing I'll add, which goes to Ann's point, I have no experience with family and friend financing, although lots of my family and lots of my friends wanted to invest in Knowledge Storm. I just could not. And the venture capitalists were perfectly willing to let that occur. That's all great if it's going well. But so few businesses end up the way that you thought they would at the beginning. And it's just one more stress in my life I was not willing to add. So I would consider, beyond the creative pieces and the control, I would consider how am I going to feel about this if it doesn't work out the way that we all felt, which happens. I wish it didn't, but it does.
The one thing, I'm going to back up just a little bit to the very beginning. The one thing I learned going through the part of venture capital that I did was when I acquired the business in 2002, we said from the very beginning, we're going to manage this company so that it's available for sale tomorrow, in 5 years, or 10 years. Our accounting is set up exactly. If somebody wanted to come in tomorrow to buy the company, we can open the books and hand it over and they can start their due diligence. Our contracts are all legally acceptable. You know, we don't have to backtrack and fix anything if anybody wants to walk in. We just started doing it the right way from day one. And when we went through due diligence for the capital raise, there was not a problem. We had very few warts, and the warts that we did have were nominal. And I would encourage everybody to start that way. And I think everybody would agree, it just makes life so much easier. It's easier to do it up front than have to go back and fix it.